Broadcast is now starting. All attendees are in listen-only mode.
Hello, hello. Anybody out there? Could you hear me okay? Okay, good. Let me get the question box opened up. All right, we're going to get started here in a second. Bear with me, everybody. I got to move this thing out of the way. I'm going to put you guys on mute for a couple seconds here. All right, we're back. We have the famous, or maybe infamous, I'm not sure, David Lerman from the CME Group here with us today for another exciting presentation. Market Spotlight presentation today is going to be on the mini Nasdaq stock index futures. Thank you everybody for coming. We're going to have a big crowd today. Feel free to use the question box. Hopefully you could find that and we could kind of take questions and answers in real time or special requests. Now, I'm assuming my voice is broadcasting here because I do not see anyone saying I can't hear you. Oh, we just got I could hear you. All right, cool. So we're going to start right on time in 5 minutes. Thanks for coming, everybody. Be patient. Thank you, Arthur. I'm just going to pause my speech here for a second. We'll be right back. Good morning, everybody. Jim Cagnina with Infinity Futures. Welcome to today's market spotlight on the mini Nasdaq 100 futures. It's a great time to be trading futures. We have a lot of volatility, a lot of price action, a lot of potential, a lot of risk, all that stuff in many different asset classes, and the mini Nasdaq is no exception. So we're going to talk about it. We're going to talk about what FANGs are and what equity traders should be considering, what ETF traders should be considering when they're looking at alternative markets to trade. Of course, I'm a little bit biased, but I think the sweetest market to trade are the futures markets offered by the CME Group. And in that spirit, we do have David Lerman here from the CME. He is the Senior Director of Education. David's been in this business at least as long as I have, 30 plus years. He's been with the CME, I believe. He has more institutional knowledge than just about anybody on the planet with respect to markets, liquid markets, tradable markets, comparisons, all that stuff. So we're excited to have him here today. He's going to do a 30-minute presentation or 40 minutes or so, answer questions, and I'm going to pop in and we're going to do look at some charts. But before we start, good morning, everybody who's saying good morning to me. I do want to do the same thing we did last time. I'm going to pull up a chart. This is a mini Nasdaq. This is a real-time sim account, okay, so don't worry about us making or losing money. I'm going to open up a trading ladder, and I'm going to ask the question, should we, at the beginning of this presentation, go short or long? And whatever we decide collectively as a group, we are going to go ahead and then flatten that position out at the end of the presentation. We'll see how we do. So go ahead and, all right, so let me do it this short, okay, good. Just type in short or long based on your preference. Looking at this chart, I'm going to kind of eyeball this. This isn't an official survey, but we could have some fun with this. We have a lot of shorts. The shorts are beating the longs at least 8-2. 80%. Well, we got some longs in here too now. Longs are fighting back. Wow, we have some longs fighting back. This is Dave, what do you think? I'm going to say the longs are winning this thing. No, we're doing it now, Michelle. We're not waiting until 10:30. What fun is that? All right, we're going long then. Here we go. I'm going to pull the price ladder up. I'm going to go ahead and do a one lot. We're going to just buy one at the market here. And now we are officially long. This is a sim account, everybody. Don't get too excited. Oops, wait, I have that bracket there. My bad. Flatten all that stuff out. All right, let's try again. Let me get rid of the bracket stuff. Quick click. We're just going market. I'm not sure why that's doing that, but it's gone now. All right, so we're long at 67.60 and a half. 67.60 and a half. I'm going to move this down. I'm trading on a sim. And I will be back in about 30 minutes. We're recording, which is good. And I'll show you how to get the recording and all that stuff after David's presentation. Thanks for being here. Oh, let me remind you, trading futures options on futures involves substantial risk of loss, not suitable for all traders. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I could afford to lose doesn't change my lifestyle, lengthen my retirement horizon, or overly anger Mrs. Cagnina. Now, I throw that last part in kind of tongue-in-cheek, but not really, because stress is part of life. And if you're stressed out, you're going to make some bad decisions, and that can carry over to your trading. So have it together and keep that in mind and be patient. Here is Mr. Lerman. Thank you.
Well, thank you, kind sir. Again, Dave Lerman, Senior Director of Education at the CME Group. He was very kind and very flattering to say that I have more institutional knowledge than anyone on the planet. That's not true. I have a lot of institutional knowledge, but not more than anyone on the planet. But anyways, so how do I flip this thing here?
You're just going to be able to use this mouse, but let me get the questions here for you so you can see them too.
Okay. Give us 30 seconds here. We're just doing the transition.
So here you're good.
All right.
So the wheel on the mouse will roll it up or down.
All right.
Oh, you can click on it to highlight it, and then it should be good. Oops. I just roll the mouse down.
There we go. All right. Yeah, just a little cup of water. So again, everyone, thank you so much for logging in. All of you, it's a very, very, very good crowd, very big crowd. We got several hundred people, which is terrific. We have this first slide up here, very interesting. It shows the S&P 500. It's not Nasdaq. We're going to talk mostly about Nasdaq, but this is the top tech stocks in the S&P 500. You can see how gigantic they are in terms of the overall part of the pie that the FANGs are. And I include Microsoft and Apple. They're not truly FANG stocks, but Alphabet, Amazon, Facebook, Netflix are. But you can see those 5 stocks account for such a huge amount of market capitalization there. When you look at the other 495 stocks in the S&P 500, they seem to just be so small relative to the FANGs and to some of the large cap tech stocks. So pretty interesting there. And it's also indicative of something. When I saw this chart and I had seen Amazon just going from 1,000 to 1,200, 15, 17, 1,800, then up to 2,100, eventually these things were going to reverse. And we've been doing this FANGs in the Crosshair seminar now. We've probably done it around 10, 15 times in the last year or two. Great potential on the upside if you're long, great potential on the downside if you're short. But in general, people in the stock market don't play the short side very much. People in the futures markets play it all the time. There's half longs, half shorts. That's just the way it is. So pretty incredible there. And that kind of like gives you a contrarian view here that these things have gotten so big that at some point, the laws of gravity apply to the stock market too. These things would have to come down and have a 10 or a 15 or 20% correction. And that's exactly what they're doing. And yet people are like screaming like it's the death of the FANG trade and all that. Well, it might very well be, but at the same time, during the tech bubble back in 1999 and 2000, during that entire decade when markets were flying higher, there were many 10, 20, and 30% corrections. There were a lot of high-tech stocks that were down 20, 30, 40%, yet they went on to make new all-time highs again. Then, of course, eventually the bubble burst and everything collapsed by at least 50%, if not 70, 80%. If you were a dot-com, you were down about 99%, and you did not recover for the most part, except for a few very fortunate companies like Amazon and Netflix, and, a few. But Cisco still nowhere near its all-time high. Microsoft broke above its all-time highs. Anyways, enough color there for the background in some of these large cap tech stocks. All right, so a couple reasons why we should consider the E-mini Nasdaq over the FANGs. We're gonna talk back and forth about the FANGs. We're gonna talk about the Nasdaq, but we're gonna give you reasons why you should consider the Nasdaq if you are a FANGs trader. Some of you don't need reasons; you're already Nasdaq traders. So we're just gonna give you more ammunition there. So. Liquidity, it's unparalleled. We're going to have a chart coming up here in a few moments that'll show that as large as the FANG stocks are, as much as that they trade an average daily dollar volume and average daily volume in shares, they don't even come close to the Nasdaq 100 futures. And that's the way it is in many, many markets. There's a lot of liquidity out there in the world, but there's a huge amount of critical mass in the futures contracts. And we'll get to that a little bit more. So liquidity is amazing. You pretty much always have a one-tick market unless we have some wild volatility, which we've had lately. It's amazing. A year ago, we were all complaining about the lack of volatility. We were at historic lows, literally historic all-time lows in implied volatility in the S&P 500. We were near it in oil, heating oil, crude oil, gold. We were at all-time lows in implied volatility. Everything was dead in the water except maybe the grains. Well, what a difference a year makes. Now everything is near its 75th, 80th, 90th percentile. They're near their highs, which is amazing. Volatility is mean reverting. It never stays low for very long, and it never stays high for very long, although it will test your patience sometimes. Another great reason why you should consider trading futures versus the FANGs, it's very simple. Capital efficiencies, I call it reasonable leverage. If you want to own 100 shares of each FANG stock using even regulation T margin, it would cost a lot of money. Amazon's at around $1,600. That's $160,000 right there. Google's around 1,000. That's another 100,000. You'd have to put up in excess of $250,000, $300,000 to get 100 shares of all of them. So that's a lot of money. With futures, you put down a lot less. Again, we'll have a chart that will do a direct comparison of the FANGs versus the Nasdaq QQQ ETF and the futures. All right. The Nasdaq futures, by the way, would require somewhere around $4,000. I don't have an updated number of margin. It's gone from 3,800 to 4,200. It's been jumping around a little bit. Margins change depending on contract size, and more importantly, they change based on volatility. If volatility screams higher, there's more risk. The clearinghouse wants more margin, as do all the FCMs, the clearing firms and the brokers. You also have the third reason, 24-hour trading. We'll have an example later why this is important, but we live in a global capital society now, global capitalistic society. The United States isn't the only place that has great markets now. There's other markets going on, and therefore there's a 24-hour basis. The currency markets have been 24 hours for about 60 years. We just, launched, 24-hour trading back in 1992, I believe, when we launched our Globex trading system. But there's always opportunities that come out of Asia, that come out of Europe, and if you can't get in and you can't get out, late at night or early in the morning, that's not good. A true trader wants to exploit opportunities around the clock if possible, although we do eventually have to sleep. You get a more diverse portfolio. The little techie, tech doesn't live by FANGs alone. And it's true. It's been a fantastic trade. I don't know if it's over or not, but there's a nice thing to say about you getting the other 96 stocks in the Nasdaq 100. It gives you a little bit more diversity, both for if you want to play the downside or you want to play the upside. There's tax advantages too to trading futures over FANGs. I think I have a slide on that showing if someone makes $10,000 trading FANGs versus someone makes $10,000 trading futures. You'll see there's a huge advantage there. And that's the hook that we use sometimes to bring people over, transition from the stock market and the bond market and options market into the futures market. If you're a good trader, you are saving yourself a boatload in taxes by not having to ship a lot of money over to the IRS. Okay? So we'll talk more about these things, and there's a couple other reasons too, and we'll get into them real quick here. And there they are. So we have, again, to review, cheap execution costs, great liquidity, capital efficiencies. All right, leverage is very, very a good thing. It allows you to take a small amount of money, control a large amount, and so there you can take your money and diversify up a portfolio really nicely because you have a little bit more. You have a little bit more capital to work with. Quick question. I'm going to answer. I rarely interrupt a seminar for a question, but this one's good. Regarding liquidity, is it reasonable to trade 100 contracts on Nasdaq? Yeah, and if you don't believe me, go to the CME liquidity tool. Very important tool. We just developed it. It has trillions and trillions of data points. It has all the bid offer spreads. It has the depth of market, and we'll show you how much the Nasdaq market will go up or down depending on a 1 lot, a 5 lot, a 10 lot, a 100 lot. And I think I have those here in this seminar. I just updated this seminar. So later on, I think just hold on. We may be able to answer that with very good precision. All right. All right, so strategic reasons, there's things you can do in futures that you can't do in the stock market. There's spreading. You can spread small caps versus technology, large caps versus small caps, mid caps versus small caps. It's very difficult. It's just much more costly to do this in the stock market. It's also a pure direct play on the markets and asset classes. Again, when you play the Nasdaq 100 futures, you get the entire technology and telecommunication industry. You play just the FANGs, you're getting those 4 stocks. That's it. Granted, there's a nice correlation, usually very tight, but anyways. Supply and demand, smoke and mirrors is absent. You don't have any accounting issues in futures like you do with stocks. You all remember Enron and MCI WorldCom and what was that, Valiant Pharmaceuticals, where there's actually outright corporate fraud. That doesn't, there's in the futures market, you're talking commodities, you're talking trillions of dollars of treasury securities, hundreds of billions of dollars worth of crude oil, if not more. So it's a pure supply and demand market, but the smoke and mirrors and the accounting and all that stuff is largely absent. We have a margining system, and it forces risk management. This is very important. I know some of this is review for you folks. That's why I'm going through it fast. But we got a margin system that forces risk management. Now, the only thing that's going to make you a good trader is having good risk management, or one of the most important things, I should say, is to have good risk management. And they say that if you don't have good risk management practices, the futures market isn't for you. Actually, I say the opposite. If you don't have good risk management practices, the futures market's perfect for you because it will make you develop them between your broker or the FCM or the clearinghouse and the CME group, because of margins, variation margins, margin calls. They will make you better at risk management, and that'll make you a better trader. Ninth reason, many successful traders trade futures. So do some of the big players, big pension funds, big endowments and foundations. Some of the most storied hedge funds with great track records trade futures contracts. So at least it behooves you to look at these things. And there's tax advantages, which we talk about, which we'll get into a little bit more detail towards the end of this. All right, so for the uninitiated, FANGs is just an acronym for Facebook, Amazon, Netflix, and Google. Some people add Apple too, so it's FANGs. It's one more A, but they're very high priced and they're very volatile. Mostly because of their higher price. They're not any more volatile than Bitcoin, that's for sure. But when you have a high price stock like Amazon, it goes down 5% in a couple of days. When you got a $2,000 stock, that's a lot of dollars. Same thing with Netflix. I mean, these are all, Google's $1,000, $1,100. Facebook's $140. So these aren't $20 or $30 stocks. Okay, here's the chart I was talking about. We're going to spend some time on this now. Spend at least 5 minutes on this. This is very important. I want you to look very closely at all the detail on this chart. We're not going to go over every box, but I want you to call attention to, all right, we have Facebook, Amazon, Netflix, and Google. We have the 4 FANG stocks across the top. Then we have the QQQ. That's the Nasdaq 100 tracking stock. It's the ETF that tracks the Nasdaq 100. Then I have a column for all FANGs, and then all FANGs plus the QQQ. And then the ICE FANG index futures. There's basically a futures contract on the FANGs traded at ICE. And then there's the E-mini NASDAQ 100 futures that trade at the CME group. All right. So the first column is this average daily volume of shares or contracts. Now, you can't compare contracts with shares. Facebook does 29 million shares a day. It's a lot. That's a good volume. QQQs do 43 million shares a day. The futures contracts don't do shares. They do contracts, and they're very, very large. You're not talking $100 or even $1,000 here. The NASDAQ future, the notional value is about $140,000 per contract. So they're very, very big relative to stocks. So we had to normalize this by doing an average daily dollar volume. So there you see on the second row there, Facebook, 5.19 billion. Let's see, Amazon, 7.8, Netflix, 3 billion, Google, 1.9 billion, QQQ, 7 billion. All FANGs put together, 17.9 billion. All FANGs plus the QQQ, 25.1 billion. And the ICE index does 180 million a day on a good day. All right. So you add all those up, you're roughly at around under 26 billion a day. You take the average daily dollar volume, though, of the NASDAQ 100, the E-mini NASDAQ 100, $63 billion. It's more than twice the size, 2.5 times the size of all the FANG trading and all the QQQ trading and all the FANG index futures at the ICE. So when you're asking about liquidity, it's pretty darn good. Is it good on a 24-hour basis? Yes, it's not as good at 3 in the morning as it is, during the opening or the close or the middle of the U.S. trading session. However, with our liquidity tool, you can go in and measure this. If you want to see how liquidity is overnight and how much a 5 lot will move it at 2 in the morning on any given day, you can do it. How much will a 500 lot move it on any given day? You can use our liquidity tool and do it. So the next row here, I just broke down now. At the time I made this slide, the notional value of the NASDAQ 100 futures was $144,000. So to the FANG stocks, there's 4 of them. That's $36,000 a piece. If I wanted $144,000 worth of FANGs, I divvied it up, $36,000 a piece. That would get you 187 shares of Facebook, 21 shares of Amazon at that time, 100 shares of Netflix, and 32 shares of Google. All right. So again, we're allowing for the fact that, we're trying to get neutral in dollar terms here. Again, stocks trade shares, millions of shares. Futures trade contracts, usually hundreds of thousands. There are some futures contracts that trade millions a day. Crude oil, the E-mini S&P 500 does, 2 million contracts a day. So it's pretty amazing. And they're very, very large, as you know. So regulation T margin requires you to put up 50%. So if you add up 36,000 times 4, that's 144,000. You would have to put up 72,000 or half of that according to the regulation T margin on the New York Stock Exchange. So that would require $72,000. At the time I made this slide, the actual margin for the E-mini NASDAQ 100 futures was $3,900. Huge, huge capital savings there. I mean, you can do a lot with that additional $68,000 that you'll be sitting there with, but that you won't have to use with futures that you're going to have to use trading stocks. The next column down, it says 24-hour trading. There's pre-market and post-market trading in almost all stocks and a couple of ETFs at a very few selected number of firms. But in general, 24-hour trading, you want to trade Amazon because there's something going on over in China overnight. Good luck. Same thing with Netflix, Google. QQQs you can do overnight at one or two firms. You can do pre and post market trading. There's some liquidity, but it's still true 24-hour trading is not there yet for ETFs or for stocks, unless you're extremely well wired into the markets. So the ICE index, yes, they have round-the-clock trading, I believe, but I don't know how liquid it is. It's still a relatively new contract. It does 4,000, 5,000, 6,000 contracts a day. Average daily volume is 1433. Excuse me. On a good day, it'll do 4,000 or 5,000. 24-hour trading, we do have it in the mini Nasdaq 100. So, and we've had it for a long time since it launched. 60-40 tax treatment all the way across there. No, 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 until you get to the ICE futures and, of course, the mini Nasdaq 100 futures. So if you make $10,000 on a trade, on a short-term trade, you're going to get an infinitely more efficient tax treatment on the futures than you will on the stocks or the FANGs. Diversification, well, you want to buy all the FANGs or one of the FANGs. There is really no diversification. You're there in high-tech land, social media, whatever, and that's it. QQQ, you get 100 issues. With the FANG index futures, you get a little bit more diversification. I don't know the actual portfolio composition of the underlying index exactly. But again, with the NASDAQ futures, it tracks the NASDAQ cash index, so you get 96 other issues. So you get just a lot more diversification. All right, so let's head on down to, all right, this is just another way of looking at this here. Just a different approach, but again, it's just a different graphic. It says basically the same thing. But in general, you given the 24-hour nature and the tax advantages and a whole bunch of other things like that, it's just infinitely superior instrument to trade, trading the futures versus the stocks. So you want to just do a little comparison on liquidity. This comes off of Bloomberg. It's a Bloomberg print screen there. I just printed off that's the best bid and offer. It's a QRM quote montage, just over a couple of seconds here. Actually, this is only 1 second. This is how active Amazon is, right near the close of trading. And you can see, actually, this is about an hour away from trading. This is New York time. So this is Chicago time. So these would have another hour to trade, actually. And you can see right here, 1695, 1697, 16, 1695, 1697, 12. It's about $2, $1.50 to $2, sometimes as much as $3 difference between the bid offer spread. And granted, it's a $1,600 stock. That's still pretty darn good. The difference between the bid and offer spread on Amazon is 0.06 to 0.10%. So that's 6 to 10 basis points. All right, that's pretty darn cheap. But in terms of liquidity and everything, if you're an active trader, what really counts is if you're going in and out throughout the day, hundreds of times a week, dozens of times a day, or even more, these transaction costs will eat away at your profits. Even if you're a good trader, it's going to eat away at your profits, and that's why you want to minimize taxes and get the most liquid vehicle you possibly can. The Nasdaq is not even a half of it's 0.004 to 0.008, so that's 0.4 to 0.8 of a basis points. So pretty liquid relative to stocks. This is good material. This is interesting stuff because people don't understand when you're trading stocks, you're giving up a lot. They're liquid, but they're not as liquid as futures. So let's get into it. Someone asked a very good question earlier about how easy it to get filled on various sizes. And I believe, yep, I have them here. This is good. How do we measure liquidity? So some people look at volume, some people look at open interest, and in general, those are very good indications. If you have a lot of volume and a lot of open interest, like in crude oil, like the mini S&P 500, Eurodollars, the 10-year Treasury note, you have great volume, great open interest, and you could do any size you want. You want to do a 5,000 lot in 10-year Treasury notes, piece of cake. You won't move the bid offer spread one tick, okay? More than one tick. Generally, volume and open interest are important determinants, but the real determinants are how tight is the bid offer spread, but even more important than that, how deep is the order book? In other words, you can have a one tick market, 7 bid at 8. But if it's only one contract by one contract, that's a little bit different than something that's 7 bid at 8 that's 500 up or 1,000 up, 5,000 or 1,000 at the bid, 1,000 at the offer. Not only that, beyond that, how deep is the order book? Are there bids a couple of ticks below and a couple of ticks above? And this is what's really important. So the truly liquid markets, and we have many of them at CME Group, the truly liquid markets like Nasdaq, like the S&P, like Eurodollars, like gold, they have a very tight bid offer spread. They have a very deep order book too. That's very well populated. So how do we get this information? As I said, the CME Group has a new tool. It's called the liquidity tool. All right, so here it is. It's take a little bit of explaining, but it's pretty easy. What I took here, this is a liquidity tool. People want to know always, what's the liquidity? What's the cost? If I make a trade, how much is it going to raise or lower, your cost of trading? And what we have here is the mini Nasdaq 100. I picked just the second quarter, July through September 28. Excuse me. Yeah, that is the second quarter. Third quarter. Third quarter. So this is the third quarter, and we have two charts down there. You see the one on the left, lot size 5, and then next to that 25. So this tells you what's the cost in general over that 3 months to trade a 5 lot versus a 25 lot. And you go way down there, you see all those green and red dots, and then you see a dashed line, and you see it's right around 1.5. So it's usually about 1.5, anywhere between 1.25 and 1.5. So that'll tell you on a 5 lot, and that's over time. That's the entire U.S., Asian, and European time zones for those 3 months. It's the Chicago time zone. You can change the time zones if you want. My mistake there. You can change the time zones and you can look at every time zone. But basically, it's Chicago, those 3 months, and what's the bid offer spread? The cost in ticks. It's usually about 1.2 ticks to maybe 1.5 ticks. So it's basically, for the most part, it's a 1 tick market. Occasionally it gets up to 2 ticks. So it averages out to about 1.2 to 1.5 ticks. It's usually almost always below 1.5 ticks. Now, let's go to the right-hand side of the chart. Lot size, 25 contracts. All right. So 25 contracts, you go on down here and you can see it's moved up, which it should. This is not the mini S&P 500. This is not treasuries. 25, 50, 100 lots is going to start to move things. But it's not going to move it by too much. So it's about, the dashed line is right around 2.5 ticks. Most of the numbers are below that. They're around between 2 and 2.25 ticks. So not bad for a 25 lot over a 3-month period now. And there are times when it's tighter than that. There are weeks where there's a ton of volume and a ton of throughput coming through the markets, and these will be 1 tick markets or 1.5 tick markets all the time. I took every data point, every bid offer spread in the Chicago time zone from July through September. So that's pretty good data. Now you'll notice here in mid to late September, you see some of these numbers go way up here to like 6.5, 7. Those are those days that you get huge violence, and occasionally the markets widen out 3, 4, 5, 6, or 7 ticks. You look during the crash in 1987 or the bubble bursting back in 2001, you saw markets expand dramatically. All right. But in general, we have pretty good over a 3-month period. You could have done this year to date. You could have done it just for the day today or yesterday, November 14th. And I've been traveling a lot. I don't know what day it is. I don't even know what city I'm in. But so you can see there, a 5 lot to a 25 lot, you go from about 1.25 ticks, 1.25 to about double that. All right. So what about a 50 lot? All right, a 50 lot here. Now, obviously, that's getting a big order. For Nasdaq, that's getting to be a big order. And now look at the bid offer spread. It's between 3 and 4. So, but for most of the time, it's more closer to 3, even sometimes below 3. So it's basically 2.75 to 3.25 ticks during that same time zone here. So again, and then in September, we had some violence. October, we had a lot of violence. We got up to 7 or 10 ticks if you wanted to do a 50 lot. The average trade size in Nasdaq's probably south of 3 contracts. So there's not a lot of people trading 50 lots. Larger hedge funds, pension funds, CTAs would trade that kind of number. But still, you want to know how much you're going to move the market. This will give you an idea. If we go back here, I have a 5 lot, a 25 lot, and a 50 lot. If you wanted to do a 1 lot, it would pretty much be 1 to 2, 3 lots. It'd be 1 tick. Although the tool only does multiples of 5. It won't do a 1 lot, which is fine. If you have no liquidity in a 1 lot, that's not saying very much about your contract. And believe me, the Merc has a few contracts where a 1 lot will move things appreciably. They're just new markets and they're relatively, they're just less liquid. Bitcoin couldn't handle much more than a couple of lots in its early days too. So, all right, so there's a 50 lot there. So we've seen a 5, a 25, and a 50 lot, and we have a pretty good measure of liquidity now. And this tool will let you do it for most of our major contracts, and that's a good thing. What is this? All right, this is the contract specs. We're not going to go over this. Most of you know these things. And we're going to continue here. Real quickly, overnight, very interesting how the market reacts. We've talked about this a couple of times. I don't know if I mentioned it in last week's seminar, but overnight liquidity is really, really important. And can you get it? Well, the answer is yes. And the election, we have plenty of examples, but the most glaring example was the election in 2016. As you all know, Hillary Clinton came into the election in 2016 with a 5 to 7 percentage point lead in the polls. She had an incumbent president backing her. She had billions of dollars, and her husband was a former incumbent president. So she had everything going for her, but there is still a slight doubt that maybe somehow, some way, Donald Trump would pull off an upset. As a result, overnight, when the futures open up, the market crashed pretty bad. The Dow was down 900 points. It hit the circuit breaker low. The S&P was down about 90 points. It had a dramatic drop. Both Dow and S&P, both they hit the circuit breaker 5% low. Then a funny thing happened. The thing that they were most scared of actually started to materialize. Trump was winning states he wasn't supposed to win. So as a result, people, you would think that the market would stay locked limit at that 5%, and the next morning when he won, the market would drop even further. The very thing they were afraid of turned out to be the catalyst for a huge rally. So as Trump started to win states that he wasn't supposed to be, the market rallied. And then when it became apparent that it looked like Trump would in fact win, the market continued to rally. And the cool thing about it is, I'm not making political commentary here. You can see there's huge amount of volume coming in, and you were able to do trades. People were able to do very large trades that night. Same thing on the Brexit announcement, same thing on the Swiss National Bank announcement a few years ago when they decided to unpeg the Swiss franc to the euro, and Swiss franc moved up 30% in about 2 seconds. And when the market, when you need liquidity, you get it now. We're not just liquid during U.S. time zones now. We're developing really good liquidity in many of our products overnight. Okay, here's the example, why you should trade futures. Yeah, if it sounds like a commercial, maybe it is, but if you want to, keep a little more money in your pocket, pay attention here, because Trader A made $10,000, Trader B made $10,000. Which one would you rather be? Well, we made an assumption, the 33% tax bracket, it's a short-term trade. Who's going to walk away with more money? Well, Trader A is taxed according to Section 1256. That's fancy term for the 60-40 rule, the Internal Revenue Code, the 60-40 rule. 60% of the gains can be taxed at long-term capital gains, which is much lower. 40% is taxed at ordinary income. In this example, 33%. The blended rate will be 21%. So you'll have to give up $2,120 to the IRS. You want to trade Facebook or any FANG or the QQQs? Trader B pays ordinary income on the short-term game of 33%. So we've got to pay $3,300. That's more than $1,000 difference. So to all you traders out there, if you're a good trader, this is substantial money that you're giving to the IRS that you don't have to. All right. So the whole point of this is, do you want to give up an additional $1,000 to the IRS for every $10,000 you make in trades? I don't think you do. And some people stood up in a seminar and said, oh, what's the big deal? I go, well, if you're a good trader and you're trading dozens of times a day or even dozens of times a week, this is going to add up over time. You do this every week or every month, that's $12,000 a month savings, or more than that. If you just make $10,000 a month trading, that's a huge difference. All right. So Trader A keeps substantially more of his profits. That one attribute alone is why we get a lot of people that change from the QQQ over to the futures, or from trading stocks over to futures as well. All right, another minute or two, and then we're going to wrap this up and bring Jim back. But I just want to talk a little bit about volatility here, because volatility is a really good indicator. It might help you, I won't say call a bottom, but one of the nice things about the stock market is when volatility explodes, you get intermediate term bottoms or sometimes some permanent bottoms. The crash of 87 was a great example of the financial crisis when volatility got to 50, 60, 70%. You knew you were near the bottom. Dot-com crash when volatility spiked to 80%. You knew you were near the bottom, and that's exactly what happened. It's pretty good. That combined with other, exponential moving averages and stochastics and RSI could be a good point here to give us the turning point when this market does bottom, whether it's 10% lower, 20% lower, or whatever. Anyways, this is just a simple chart, volatility. It's implied volatility, 3 years ending November 6th of 2018. So very reasonably up to date. You can see on the lower end of the things, 9-10% is on the low side for Nasdaq implied volatility. 25 to 30% is on the high side. So we're more towards the high side now. We're above 25%. We've had this violent move down in October and now in November. And things could go dramatically higher. I've seen Nasdaq volatility, hit 50% sometimes. Actually, during some of the dot-com meltdown, Nasdaq was moving 300 points every day. So it was moving quite a lot. But is there a better way to drill down on volatility? What's cheap? What's really cheap? What's expensive? What's really expensive? So we've done this before. We've talked about it. It's called volatility percentile rankings. We take the same data that we did to make that chart, but now we just put it in a table form. And it's very similar to our when we went to college and we took our SAT or ACT tests. If you scored 790 on the SAT, you were in the 99th percentile, which means you beat 99% of the people that took the test, meaning you're pretty bright and you went to a very prestigious college. All right. If you scored in the 25th percentile, you beat only 25% of the people that took the test, and you either took it over or you did not go to as prestigious a school. It didn't really matter. Intelligence, I may add here, intelligence has absolutely no correlation. High intelligence and smarts has no correlation to successful trading. There are MIT and Stanford graduates that blow out in a couple of weeks, and there are high school dropouts that make $800,000 a year in and year out, that are members of the Merck or other exchanges and stuff like that. So be careful. If you think you're smart, it doesn't mean that you're going to do well in trading. Street smarts is better. Discipline and risk management go much, much further than a high IQ or 4.0 GPA. So the high in the last 3 years is 30.38. The 90th percentile is 21.30, which just means 90% of the time volatility is lower than 21.30 in NASDAQ options. 10% of the time it's higher. So what does this tell you? If you're in the 90th percentile, it's buy low, sell high in options premium too. If you're in the 90th percentile and volatility is lower 90% of the time, what's that going to do to your options? Well, yeah, that giant sucking sound that you hear is the premium coming out of any long option positions when you buy in higher volatilities like this. Now, of course, it could go higher. We can go from the 90th percentile to the 99th percentile. I've actually seen it happen 3 or 4 times in my career. It can happen. It's very rare, but it can happen. Same thing, 25th percentile, 10th percentile, 90% of the time volatility is higher. Well, what's that going to do to your position, your option, long options? It's going to help it. Higher volatility will help it. Of course, you got to remember, options are 4-dimensional instruments. You have to worry about time decay and the relationship between the underlying and the strike price too. So you have to worry about 4 items. When you buy futures or buy stocks, you only worry about up and down movement. If you're long, you want it to go up. If you're short, you want it to go down. With options, you got to worry about time to expiration and implied volatility changes. So I have in the last column there, all right, I have the 10th percentile. In the 10th percentile, volatility would be 11.09%. That's the 10th percentile. 90% of the time, it's higher. What is the straddle cost? Well, it's 175 NASDAQ points. They're all worth about $20 because that's the contract spec. So the straddle costs $3,500. Let's just say we went from the 10th percentile back up to normal, average, 50th percentile. Straddle goes from 175 to 218 or $4,360. So the whole point of these tools is to weed out trades or to try to get you to buy on the lower end of the continuum. All right. If you if you're going to be wrong buying options, I'd rather be wrong in the 10th percentile than in the 90th percentile. Look what happens if you buy a straddle in the 10th percentile. Your risk is $3,500. If it goes to zero and we stay right at the money and the markets don't move at all, you'll lose the entire premium, $3,500. But what if you're wrong in the 90th percentile? If you're wrong in the 90th percentile, you're going to lose a lot more money. It's going to be $6,700. So the whole point here is to, buy low, sell high in terms of volatility too, and try to keep your long commitments to the lower percentile rankings. And if you like to sell options, which be careful, you better have very deep pockets and very good risk management. You want to do that in higher percentile rankings. You'll stack the odds more in your favor. That's all I'm saying. Just real quickly, here is a quick calendar sort of that shows in what products that we have end of month weeklies, Monday weeklies, and Wednesday weeklies. With Nasdaq, we only have weeklies and we have end of month. All right. And we also have quarterly, but we do not have Monday and Wednesday weeklies. In time, maybe we will. Only with the mini S&P do we have those. So that just about does it here. We'll get Jim back in here now. A couple other things real quick. I'll take a few questions too. For seasoned traders or people that are just getting started, we have the cmegroup.com, our website. We also have the institute.cmegroup.com. Plenty of seminars, videos, webinars, learning materials, and it's all free. So let's look at some of the questions here. Regarding liquidity, is it reasonable to trade 100 contracts in Nasdaq? Well, yes and no. Yes, if you don't mind giving up 5, 6, 7 ticks, depending on what time zone and what day. On some days, 100 contracts will be eaten up pretty quick. But go to the liquidity tool and put in 100 contracts and see what happens. Nasdaq's average intraday price swing. Oh my, you can calculate that. Volatility is running around 25, 30%. Divide 30 by 16. That's a percentage. So it's moving average. It's about 1.5% a day. So whatever 1% of 69.60 is, that's what your average intraday price swing is. All right. How easy is it to get filled on a 24-hour basis after the market closes? Again, if you're doing 1s, 3s, and 5 lots, it should be no problems getting filled within a tick or two, or maybe 3. Again, it depends on the particular day. If there's a lot of volatility in the markets, the bid-offer spreads will be larger. All right. Question, is the liquidity tool designed for Nasdaq only? No, it's designed for all our major products except Eurodollar futures, which you don't have to worry about because Eurodollar futures are the most liquid futures contract on the planet. You could do a 10,000 lot order and not move the bid offer spread. Can we get the slides? Yes. Jim Cagnina and Mr. Mooney have permission to send my slides to anyone they want. All right. Any other questions? Oh, were the bulls or bears right? Well, Jim will go over that to you. He'll look at the trade and how it's doing and stuff like that. But someone has a, you ready, Jim? All right, just one more. There's a question here about the $10,000 differential between Facebook and Nasdaq. Someone just did the math on it, and I had a difference of 35.75%, 1/3 difference due in taxes. Again, it depends on your tax bracket, and always talk to your accountant. I am not an expert in accounting, but the blended rate is usually around 21, 22%. I verified that with some accountants, and that's the way it goes. But again, for different people, it'll be a little bit different. All right, so again, talk to your accountant. And I'm going to put Jim back on now, and you'll see how your trade did. So thank you all for listening in.
All right. Thank you, David. Appreciate you coming over here in the snow, nonetheless. It's snowing here in Chicago. Probably snowing where you're at, too. It's snowing all over the world, it looks like. Let's go ahead and pop some charts up here and talk about this market a little bit. Get the screen situated. All right. Somehow I made a pilot error on my entry here. We got in at 67.60, and right now we are trading at somewhere up here. No, yep, 68.22. So 67.60 minus 68.22 is 62 points, And in this particular market, 62 points, you're going to multiply that by 20, and you're going to get $1,240 per contract differential. And in this particular case, this was a winner-winner chicken dinner. So, but it could have went the other way. Keep that in mind. Past performance not indicative of future results. Sorry about my execution here. I had an order and I forgot about and ended up muffing up the dome. But still, it was a good long. I guess Mr. Dannenberg, one of the first ones to call the long trade. Mark, thanks for being here and good call. And then a lot of the other guys followed up on that. Remember last time we did the crude oil short. It was the short of the century because that crude oil market kept on going down and down and down. And let me just show you real fast before I talk about this technical analysis ideas on this. We're gonna record these. These are recorded, and this webinar will be put on our YouTube channel, youtube.com/Infinity Futures. And this is the crude oil one that David and me did last week, 2 weeks ago. And then it'll be on this uploads panel here, the one that we did today. So feel free to go and replay it, share it with friends, talk about it, watch it again, ask me questions, all that stuff. Charting Club's the other place it's going to be. This is specifically for Sierra chart people, whether you're an Infinity customer or not. It's a membership site. It's free, and I've done, I don't know, about 60 how-to videos so far, maybe 70. I'm adding 2 or 3 a week. So this will be a complete library of everything Sierra chart, how to add different things on the charts, how to code different things. It's kind of cool. So it's free. Just go ahead and log in, and you'll get an email saying, hey, confirm your email. And once you do that, you'll be in business. Someone asked, what do I have to pay in taxes? All right, let's forget the tax part of this thing. Let's look at the trading part of this thing. This is a daily chart. This is my daily chart. I like to look at this, and it's a daily candle chart. And it's not very complicated what I have up here. I have a 50-day moving average, 100-day. These are exponential moving averages, by the way. 50, 100, 200, 300. And you can see we're trading right at the 300-day moving average level as we breached it. We closed below it, which typically isn't a good thing, but we did close below it. Today it looks like we're fighting back a little bit. Okay, so that's one thing I like to look at. We had a nice crossover here, the 50 and the 100. I'll try to move my crosshairs up here. And this proved to be interesting because this cross, it took a couple days to work through it. I have a pink inside. I got a pink cross. I even color coded it pink right here, and we did pop back up. But we drove down from the high of October 3rd to the low of October 29th, and then we retraced past the 38.2% retracement, and we tried to get to the 61.8% retracement. We didn't make it, and then we came back down below. So this trend reversal that we've had here, let me go back a whole year, is a real deal. It's a real trend reversal. Now, we'll see if we maintain this low from October 29th or not. That's going to be the next big question in my mind. And this red line I have here, dotted line here, is where we started the year. So we're still 400 handles or so above where we started in January in this market. So when people start talking about returns on investments and all that stuff from the stock index markets, we're still okay from a 401k point of view, hopefully. At the bottom here, I have a slow stochastic. It's just real simple. I take the default settings here, and it's my oscillator, I guess you would consider that. And right now we're 35.34. 20 line is the magic number, but this also is pretty good. It's a lagging indicator, right? It's not going to give you the exact answer, but it does kind of help you figure out where you're at here. And sure enough, we breached the 80 level on the slow stochastic right when the meltdown started. And you can kind of consistently move your crosshairs across to take a look. How accurate is this thing? Is it meaningful? We crossed the 80 below. We crossed under the 80 here. We crossed under the 80 here. We crossed under the 80 here. So those are the kind of things that I like to look for when I'm establishing a long-term bias. Already asked why the exponential. You could do a simple moving average if you want. I know I probably should do a simple moving average with 300 days. The exponential kind of focuses on, it kind of exemplifies the more recent data over the older data. But I don't know. It's just a habit. Either way, the lines aren't going to be that different, to be honest with you. But that's what I like to look at. In this particular view, in my mind, and we talked about this at the last crude oil one, it's establishing bias. What's the state of the market? Are we in a bull market? Are we in a bear market? Are we in a sideways market? And this was, we had a trend reversal here that was confirmed, in my opinion, and now we're in a bear market, at least for now. I mean, that's my opinion. I could be 100% wrong. And that long trade we made at 67.60 in the simulator today, maybe that was the start of something good. Maybe we're going to rally here. I don't know. But I see that low at 65.79. And in the back of my head, I'm thinking we're going to probably try to attack that. And I hope I'm wrong, but I don't know. We'll see. Bonds are rallying like crazy. That's another thing. It's a little bit of a fear gauge in my mind. And I know there's stuff with Brexit that's affecting bonds. Let me just pull it up real fast. We're going to talk about the bonds at the next Market Spotlight with David Lerman. I mean, all right, so we kind of retraced a little bit back. But, I mean, we were up at 39.10. That's pretty high. This was, hang on, no. Sorry, my data is not, 39.13, 39.14. And we're at 39.5. So this is a pretty big, pretty high level for bonds right now, given the fact that we're supposed to be in an environment where interest rates are going to be creeping up. So there's a little bit of a fear factor here, which kind of helps support this stock market, equity markets, not only in the mini Nasdaq, but in the Dow and in the S&P and in the Russell. So anyway, that's my bias right now. Let's take a look at the next chart I like to look at. And again, I have the stochastics at the bottom. This is a 30-minute candle chart. And I like to look at yesterday's high, open, close, and low. So I have my Sarah chart here, and it's a real simple study. I mean, it's daily open, high, low, close study, and I just have reference days back set to 1, color coded a little bit, and boom, you got some lines. And so when you're looking at the market here, you can have a reference on, what happened yesterday. What was the high yesterday? Where do we open? Where do we close? And right now, right between the open and close yesterday, and we're a little higher, right, than the close, and that might be a good sign for some folks as well. So this gives you areas to consider as support and resistance. It gives you areas to consider where to put your stops and where to put your entries, right? There's 1, 2, 3, 4 very distinct areas here. Let's dig deeper, a little bit deeper. I have a 15-minute chart, but that's not helpful to me. I like to look at the market profile. This is the market profile, and the way I set this up is 2 ways. This first way I set the market profile up is with overnight, from 5 p.m. the night before. This market trades all night, all morning, all day to 4 p.m. the next day. And so it gives you a lot of data, because things happen overnight, right? Things happen if there's some announcements that happen, in the evening, or if there's a earnings announcement or a change in leadership, and then if any geopolitical stuff that happens, and then Europe opens up at 2 o'clock in the morning, Chicago time, and then there's more institutional trading and retail trading and commercial trading in these markets, and where they form opinions also in the middle of the night. And maybe we'll go back to the 30-minute chart and take a look at what happened last night. But the market profile for this 23-hour period oftentimes gives you a really sweet bell-shaped distribution. This is a normal distribution, Gaussian distribution, if you remember from high school algebra. For me, which was many years ago, and it gives you a couple of areas to consider. The middle area, you have the value area, it's called, right? Let's see if I could I don't want to do that, because value area here is in gray, right? This is 1 standard deviation worth of pricing. Every half hour you get a different letter. Every half hour there's a new price traded, you get a letter. Okay, it starts with A and goes all the way through. It keeps recycling until smaller, small case letters. So right now, HIJKL, we're on the L 30-minute increment. These are 30-minute increments. The blue on top is prices above value, and the blue on bottom is prices below value. Now, this initial load or initial balance, whatever you want to call it, basically just outlines the first 2 periods or the first hour of trading. It's called the initial load or balance. I forget which one. This point of control, this red point of control, is the most frequent pricing, right? The most frequent time, the most times that in any 30-minute increment this price traded at. There's a lot of price happiness there, people would say, right? It keeps drawing back to that price. So that's a good magnet. And there's a lot of market profile traders that say, hey, when we approach the top of the value area, then I want to sell the market in hopes that we go back down to the point of control, and I'll put a stop, above up here, prices above value. Alternatively, the opposite, we're trading below the point of control, and maybe we want to go long because this is going to act like a magnet. This point of control is going to act like a magnet, and it's this is where the market over a certain period of time finds its buyers and sellers are happy. They agree to transactions there. They like this price. Right now, we're trading at markets prices above. Before I talk about that, I want to go to my second market profile setup, and this just tracks the U.S., right? So what I've done is I said, hey, I don't care what happened last night. I want to look at what happens. I want to look at what happens in the U.S. session only, when the New York Stock Exchange is open, and that's 8:30 Chicago time to 3 o'clock in the afternoon Chicago time. And so, the A period, right, is 8:30 to 9. The B period is 9 to 9:30. So we're only in the E period here because it's not even 11 o'clock yet, and at 11 o'clock we'll get the F period. So this gives me a different view, and it says, hey, okay, a lot of stuff happened last night, but when the U.S. opened, here's what happened. Here's what the U.S. market is doing, and we're mirroring it in the futures market, or the futures market's the leader, depending on your point of view. So right now, again, we're trading at prices above value, and we're about to trade above the initial balance right here as well. So one trade idea, of course, is let's see if we get an F period up into prices above, and then consider going long. I know it's a little counterintuitive because you're thinking, well, maybe this point of control here is important. But we had a different point of control yesterday, which was higher. And we breached the low, right, yesterday's low. We breached that J period by a lot, violently. We went all the way down to 67.10, which, by the way, outlines the risk associated with some of these markets, and that is make sure you have your stop in. You're going to be wrong sometimes, as I am. Maybe I'm wrong a lot, but you're going to be wrong sometime, and it's okay. Put your stop in, so you're not going to take an extra $400 worth of heat per contract if you don't have to. So in any event, we broke down, we crushed this low, and in the C period we traded way down here. Now the C period again is it's not 8:39, it's 9:30 to 10. Right, 9:30 to 10. And since then, we've been trading up higher. So my gut feeling at this point is I'm looking at places to buy now because, we got that out of our system. Now, there's news going on. There's other markets are moving. There's other things to consider. But just from a basic charting point of view, right now, we'll see where the F period ends or starts. But this is looking like actually a good place maybe to go long. Now, this is, again, my opinion. I could be wrong. But let me draw a line here, a line in the sand here. So let me make this red. This would be an area where you would place a stop, or this would be an area where you would try to get long if you're bullish right now. And it's, I don't know, 8, 9, 10 handles. That's $200 worth of heat if you were to get long right now. And use that as your stop, which, isn't unreasonable amount for a one lot in this particular market. And the steam, if you saw this market this morning, it was all over the dome. The trading ladder was incredible, incredible. It was moving off the mark, and you had to be swift with your mouse and with your roller to get your orders in and to get your orders out. But the trading ladder itself is designed for this, and it's an excellent way to get going here. And you could center it also if you want to, if you prefer to center your dome. I don't like to center it. I like to kind of keep moving it, keep being engaged if you're day trading. All right, so where are we at? Any questions yet so far for me, Jim Cagnina? Type them in. All right, Greg says, Jim, the grid you have with all of the symbols. Oh, you mean the quote board? Is this what you mean, Greg? I just have my screen. Yeah, I got my old man screen. Everything's bigger because I can't see anything. You know, I don't. There's not a real good way. There are some properties here, and there is some ability to change some colors on this thing. But there's not a really good way to trade font. I haven't found a good way to change font sizes to really make it a lot easier, unfortunately. But I just mess with my monitor to get it right. Thank you for that comment. I love these events. When's the next one? I think next one's in 2 weeks. So we're going to cover interest rates. I'll make sure everybody gets a notice on that. Bonds and notes, they're great markets to look at. They're great interactive markets, and they're really tradable. Fees are really low on the bonds and notes, CME fees, our fees, and you know they move. They're tradable. They're really good markets. So we're going to have a really good presentation on it. Thanks for that question. The letters represent, all right, so every half hour we're going to get a new letter. We just got a new letter because we're in the 11 to 11:30 time frame. And when a price trades in that time frame that hasn't traded before, then the computer is going to write an F next to that price. Okay, and you can see that in the F time zone so far, we've already traded in this short amount of time. Oops. Let me get my pointer here. You know, here's the first one, second, third, fourth, right? So we have 4 of them up there, and that ranges from approximately, you know, 04 to 20. Okay, so over time, every half hour, you're going to get a different letter, and it's going to form this profile. It's going to form this, I don't know what you call it, this distribution. But the idea is over time, it shows you, it's not volume profile, it's market profile, but it shows you the time frames and where prices are more popular. And oftentimes, like I said, you end up with a normal distribution, not always, but sometimes. You could put them all in your own column if you want. If you wanted to, there's a way to do that. Let me see if I could figure it out quickly. Letter blocks in own column. You could do it like that if you want. You could. That's a good way to view it also. It shows the letters every half hour. So 8:30 to 9, 9 to 9:30, 9:30 to 10, 10 to 10:30, and so on and so forth. Now we're in 11 to 11:30. So you could do it that way also. But that's a good question. Yeah, so it's another good point. Yeah, if you request a demo, this is a real time. Anybody could have this for free for real time for 30 days. Practice account, along with the trading ladder and all the stuff. And there's some templates, pre-made templates, built into the demo. If you want, all you got to do is ask and say, "Hey, I got this. I got the demo. Let me show you how to get that." Joe, let me follow that up here. If you just go to infinityfutures.com, and you get an immediate email. You click on Learn More, fill this out. You're going to get an email with your username and password right away. You'll be able to download and set up. Okay, but thank you for that question. All right, how are we doing on questions here, guys? Sideways histogram, yep, that's a good one. Good way to put it. And you could see already, let me just go back to the profile. I mean, we've been in this little range right here. You know, we suggested where to put our stop, where we would have got stopped out unless we would have already taken profit. Don't forget, from 68.10 to 68.20, that's 20 handles or $400. That's a big, big move. You don't have to be that. I don't know what they say. Pigs get fat, hogs get slaughtered. You know, so that's important when you're putting orders in this market. Now, margins on this, overnight margins on this market just changed. I know David threw out a number there earlier, but literally as of today, the overnight margin to hold a position overnight is $7,700. And the way margins, exchange minimum margins work is they do a calculation to figure out what the volatility is in any given market, and then they do the same thing for all their markets, whether it's cotton or soybeans or whatever market you're looking at, and they come up with a risk-based overnight margin, and that changes. It's not always set. It's not always fixed. It changes every once in a while. And, you know, we've seen these. I went back to the daily chart, and we have some pretty big candles, some pretty wide candles. And that's kind of going to give you a little clue on when span margining might kick in, and they might change a little bit. So we're 7,700 a contract now. Day trade margins are a completely different thing. Keep in mind, the lower the day trade margin, the riskier the trade, right? You're magnifying your risk and reward based on the amount of capitalization you have in your account. So keep that in mind. But day trade margins are, with Infinity anyway, we haven't changed them. We've kept them as low as $500 per contract for the stock index futures. But again, you know, be careful with the day trade margins and use them gingerly and be patient. But we do have that flexibility to give you a little bit more if you so choose. Any other questions? Pattern day trade rule? No, I mean, so all right. So just to kind of focus a little bit more on the benefits of trading futures markets, especially the stock index futures versus, say, a SPDR, you know, an ETF or just a regular stocks or, you know, whatever cash instruments you're going to use, options. There isn't a minimum amount other than the margins that we ask for. There isn't a pattern day trade rule where you have to put in a minimum amount, you know, 20,000 plus in your account. You could fund a futures account with less. And still have more bang for the buck, as David pointed out earlier. You don't have to wait to get in and out of a trade. So let me give you an example there of what I'm talking about. So I'm going to go ahead and just put in let's do a scientific trade here. Let's go back to my market profile. And I want to go long at a certain point. I'm going to put my stop at a little above 02, right? So anatomy of a trade 101. This is, let me cancel everything, make sure there's nothing dangling out there. And I'm going to go down and say, you know what, if we get closer to this 68.10 number again, I want to go long. So I'll put my limit order in here, there. And then what I'm going to do is I'm going to put a stop, right? I just clicked in the blue column, limit order's there, it's at the exchange, I just got filled. You can see my fill is at 68.12. So now I want to put a sell stop, right? We're going to put it down a little bit above 62.50. So let's just say, I don't know, 65, right? It's going to be a sell stop. It's a protective stop in this particular case. And so it's there right now. Now I'm taking, that's 7 handles worth of, $140 worth of stress here. On the bottom here, you see my open P&L, $25, $30, $50, $45. That's moving around in real time, right? That's moving around in real time. So when I close my position out, I won't be long 1 anymore. I won't be plus 1 anymore. I'll be zero, right? If I sell one, either from a stop or a profit target point of view. And so we could pick a profit target. I don't know. Let's just randomly say if we get up to 68.20, we'll scroll up to 68.20. We'll put a sell limit order in just by clicking in the sell column. This is the sell column, buy column, or bid column, ask column. Ask column is also referred to the offer column. And so now I have a couple of orders in there, right? I got a sell order as a profit target. I have a stop, and I got stopped out. As fast as that. All right, so that was quick. I don't want to cancel all because I want to cancel that profit target, and my trade idea was wrong. Okay, my trade idea is wrong. But the point is, now that I'm flat right now, I could go ahead and I could buy another one if I wanted to. I don't have to wait. I could buy another one if I wanted to. Or let's go ahead and let me just sell one to get out of this position, right? Or now I'm flat again. Or I could sell one first. I don't have to buy one first. I could sell one first, right? And I can go short. And so I could do this repeatedly based on whatever my trading methodology is, or my trade idea, my trade plan. I don't have to wait for anything to settle or anything like that. It's just automatic. You can keep going. So I don't know who asked that question, but that's the answer. Okay. Andrew, yeah, it should support 4K, although I'm not a computer geek by a mile and a half. All right, any other questions or things you want to see here? Yeah, and that's a perfect. Okay, so someone's asking me about my trade idea, which was we got stopped out, right? It's bad. You're right. Another way to look at the market is, hey, if you're still not bullish right now, or if you think we're going to trade within the market profile, then one trade idea, one idea that people are interested in is selling when you get to the top of the value area, and then putting your stop at prices above value. The idea being, well, the distribution's lower, therefore the probability that we're going to go lower is higher, right? So in that particular case, since we're short already, we'll just leave it there. Our stop could be anywhere up in prices above value or even above the high of the day, since it's not that high. And then again, as this market goes down, are we going to get to 67.70 or not? That's a $600 move, by the way. Or is there a better place to get out from where your target is? And yeah, there's a lot of better places to get out. But you'll see a couple of indentations here, right? You can consider this a little bit of market weakness, and maybe this will fill in at 67.90, right? Maybe we'll get an F to print in 67.90. And if that's what you feel like, then you're going to simply just scroll down to that price. It's way down here, but this market moves quickly, and you're going to pop one in. Put a limit order in to buy. This is a short example. Okay? And our stop, I don't know, let's put it up here at 20. And again, we're short now, so our stop's going to be a buy stop. A buy stop, and we're going to just click it in there. And we have that working. So with Infinity AT and with us, the stops and the limit orders are sent to the exchange. When you get this confirmation on your trading ladder, when you see you have one working as a limit order at 67.90, that's at the CME group waiting in line. Remember, it's first come, first serve in futures trading. It's waiting in line. You're waiting to get filled. You have an order ID number associated with that. And until you cancel this, it's going to be working. Okay? It's going to be there in the order book at the CME group. That's the cool thing. And oftentimes, almost always, if you have a reasonable internet connection, this sending orders is to and from is literally that fast. I mean, you're going to get these fill confirmations back right away. Right click on your mouse and it cancels them like I just did. Okay, I know a lot of you guys in this webinar today know this, and you're customers and you've used this platform on and off. But with the mini Nasdaq, keep in mind this thing moves fast. This thing moves fast, and it's traded in quarters. $5 a quarter, $20 a point, and you need to be prepared for that quickness, that swiftness. So in this particular market, as painful as it could be, get your stops in, get your targets in, and then you got some friendly buttons over here. You have a cancel all and a flatten. Things are moving quick and you lose track of what's happening. Cancel all cancels all working orders. It will cancel limit orders and stop orders. It will cancel them outright. Flatten does two things. It cancels your working orders and flattens your position. So if I'm short one right now and I hit flatten, I'm going to go ahead and do that. It will buy one at the market for me, and it'll cancel my working orders. So they're not up there anymore. I'm all good. 20 is gone, and the one below is gone. And we don't have to worry. The center button, we're back to where we started. So, yeah, and I even like to hit when I'm out of a position, I even like to hit the cancel all button just in case I forgot something, or maybe I had one of these automated brackets on, like I did this morning when I don't know what happened this morning. We got filled on our order when I didn't want to because I forgot I had one dangling. So it's good practice to do that. Joshua, unfortunately, the answer to that question is no. Joe, orders go right to the exchange. Bracket orders are pretty easy to do. I mean, let's just do a simple bracket with a profit target of, I don't know, 10. I don't know who has a profit target of 157 on here, but let's go down to 10. we'll do a 10 and a 10 on here. But once you set your profit target, then you're going to have to stop your. Could I just type in 10? No, I got to go all the way down. We're breaking down here, everybody. Remember, our long-term bias is still down. We established that from the chart, from the daily chart. So let's just go 10 and 10. We'll probably get stopped out on a 10 and 10 in the Nasdaq. So let's make it, so what if we do? All right, so I'm going to hit center here. I'm going to have quantity, I'll set to 1. I'm going to click automatic, right? I want this to be automatic. So when I send an order in, I'm going to get filled somewhere. And then a profit target of 10 is going to immediately appear, and a stop loss is going to immediately appear. So let's just go ahead and try to put a limit order in. We got filled, and then my stop is 10 down, my target is 10 up, and whichever one gets filled first, the other one will automatically get canceled, right? So I don't have to do anything. My hands will be off the mouse. Let's see what happens. Let's see if it's a winner, chicken dinner, or we get stopped out again. The patient, I know. Whenever we put a trade in and we actually want to see something happen, we sit here and we wait and we wait. There we go. So we got filled, we got hit, it was a winner, and notice the stop is gone. It was automatically canceled. I think that hopefully that answers your question. And you could do it short. Let's do a short version of the same trade. So let's just go, and that was a limit order where I had, since it's check, quick click, no matter how I get the fill, this bracket's going in. It could go in on a stop, it can go in on a limit order, it could go in on a market order. And so we're going to go ahead and just, we'll sell one here. Let's see if we get it. And I'll show you one more trick, although it's a little dangerous. I don't know if it's, be careful with this one, but I'll show that one in a second. Let's go ahead and, how could we not get filled on that? Come on. There we go. All right, we're short at 68 even. We have our, oops, something, what did I do wrong? Did I cancel it? Let's get it back in here. All right, I sent it. What I did was I hit auto uncheck, and I sent it again. We're still short one, and the same OCO is good to go. Now, one of the things I'm going to show you in a minute is you could enter, let me show you this. I'm going to hit flatten, I'm going to get out. You could enter on what's called a stop. So if you think there's going to be a breakout, this is a good example. Let's say I want to buy one on a stop. The stop is, oops, enter a quantity, take the bracket off. This is no longer a protective stop. I don't have a position. I have nothing to protect. Tony, I will give you $15 of SIM money. Give me your address. All right, so it's protective. This isn't protective. This is entry. So now I want to buy one here. I'm going to get some slippage because it's a market order. Stops are basically market orders, right? So you're going to get slippage depending on the bid offer and how quickly the market's moving. Keep that in mind. And the same thing with stops. But if I want to go ahead and let's put our, I don't know, our target up here. So that's a different kind of trade. The anatomy of that trade is different. The anatomy of that trade is, hey, if we swing up and we shoot up with some kind of momentum, then I want to get long. So yeah, we got 2 ticks of slippage there. We got long at 68.50, and you can see I'm long one here, and I have my target up here at 68 even. So that's another kind of little trick. You got to be careful though with the mini Nasdaq because you are going to get slippage on that entry. Okay. A better way, Tony, to do it instead of break even 1 or 2 is either with the trailing stop or just to manually move your bracket up, and the bracket instructions still remain in effect. Prince says, I am a newbie. I do end of day orders. But I'll leave out that sentence. But this webinar has opened up lots of new things for me. A bit complicated, though. Okay, well, it is, but it isn't. The main thing to keep in mind here, guys, is the market does one of 3 things, right? It either goes up, it goes down, or it goes sideways. It stays the same. And you want to buy low, sell high, or you want to sell high, buy low. And you're going to do analysis just like you would in any other market. And you're going to put trades in through a trading ladder, which is simply you're just clicking a mouse at whatever price you want. It's really easy to enter an order. So that's kind of number 1. Now, if your strategy is, hey, end of day I'm going to go long, or end of day I'm going to go short, and I know a lot of options folks do that, especially when we have big blowouts in the QQQs. And you want to, all right, so at the end of the day, I'm going to buy a call rather, because I think we're going to have a pretty easy reversal tomorrow morning or within the next 5 days or so. I see that strategy a lot. Well, you could, in futures, what you would do here is, don't forget it's 23 hours, right? So at the end of the day, you could put an order in as long as you have overnight margin. And the weird thing is overnight margin is only 1 hour long. So this market closes at 4 o'clock Chicago time and reopens at 5 o'clock. So you have that 1 hour where overnight margins kick in. Alternatively, if you don't want to put an order in right at 4, but you'd rather wait till 5, you could do that. And now you're back to day trade margins if you want. Be sure you put your stops in, though, because overnight things happen, especially when you're sleeping. Pat, stops are at the CME servers. Thanks for asking that question. All right, what else could I cover, guys? What else is interesting or not interesting? I'm going to go back to the daily. I'm going to leave this up for people to ponder. Again, my bias is not good. I hope I'm wrong. But it's looking like we're going to test the 65.79s, 65.80s. Tracy asks if I trade at 3 a.m., am I using overnight margin or day trade margin? You're using day trade margin. Day trade margin is good for 23 hours in a row. I know it sounds crazy. It's kind of weird. Even though it's at night, it sounds kind of weird. But again, have your stops in and be careful. And don't be overly aggressive with the day trade margins. I promise you that's a recipe for badness, right? And badness is losing money. Goodness is making money. All right, so we got out of that trade. That was nice. So the one thing that we've seen since we've been talking today, let's go to a 15-minute chart. And let's say we started at, what time did we start, everybody? We started at 9. No, we didn't. We started at 10 o'clock. Let me just get my tool. Let me get my rectangle. Let's find 10 o'clock. Let's put a rectangle around it, and let's extend it. Where's my extending it? And that's the range we traded more or less. I know I'm not perfect on my range since we've been talking. A low of around 67.40, a high of around 68.25. That is what? I don't know, 67, 85 handles. times 20 bucks. What's 85 times 20? I'm so old I got to use a calculator. $1,700 per contract total range top to bottom. So if you bought the top, sold the bottom, you lost $1,700. You bought the bottom, sold the top, you made $1,700. You know, and then minus your commissions and fees, which are negligible compared to that on a one lot. So this market moves. There's a lot of opportunity, whether it's day trading or position trading. And I think that's the point David was trying to make. It's very efficient, too, and very easy to set up an account. Last question. Peter, Jim, what is the break between 3:15 and 4 o'clock Chicago time? Also, it's a double question. Also, is there a flat line? As there is a flat line in the futures market. Okay, so that's a really good question, and let's go back in time here to yesterday. So everybody, I'm going to talk Chicago time. Central time is Chicago time. That's where we're at right now. And New York market closes at 3 o'clock. All right, so that's, what is that? 3 plus 12 is 1,500 hours. Here's a 15-minute chart. So at 1,500 hours, this bar is the close, right? 1,500 hours is a close. Now, the next bar is 1,530. Well, what happened to the 1,515 bar? There's a 15-minute maintenance period. There's a 15-minute maintenance period at the CME. So between 3 o'clock Chicago time and 3:15 Chicago time, the stock index futures markets are closed. They're halted. They're not closed. They're halted. I'll use the word halted. So at 3:15 then in the afternoon, they go back on again for 45 minutes. They go back on again for 45 minutes. And then they close for good at 4 o'clock Chicago time. So there's a 3 to 3:15 minute period where it closes. There's a 3:15 to 4 o'clock period when New York is closed, but this is still open. And there's an hour close, and then we start the whole shooting match over again at 4 o'clock or 5 o'clock that day. Okay, so there's two halts. There's the 3 to 3:15, which is just the halt, and then there's the 4 to 5, which is the close. Okay, and then usually nothing happens. You're right. People are cleaning up positions, and that candle's kind of little, but sometimes there's an earnings announcement. Sometimes there's something crazy happens. But to initiate a position at that point usually means you're initiating a position for the overnight for a longer period of time. So that's a little weird nuance, but once you get used to that, you're fine. Most day traders are flat at 3 o'clock Chicago time when the New York closes, and that's usually a good practice. All right, everybody, I've kept you way, way too long. A couple things to remember. If you want to try a practice account, well, a couple housekeeping things. I'm going to send everybody email with a link to the recording of this event if you want to see it after the fact. And along with some contact information if you want to come back and ask me questions or need help setting up an account or a demo account or anything. Okay, that's kind of number one. In the meantime, if you want a practice account and you want to try this in real time, try the charts, try futures trading. We'll give you access to some of these markets. You're just going to click on the Learn More button on the Infinity Futures website. This big green button in the middle. Fill out this form. You will get an immediate email with a username, a password, and a download link. Okay? Resources. Infinity Futures YouTube channel not only has webinars like this archive, but a whole bunch of playlists. Patrick Zielbauer, my associate, has done a lot of really good how to use the trading ladder, how to use the charts, how to set up different things. There's a whole bunch of really good videos on here to help you kind of go through the process. That's two. Number three, chartingclub.com is another place where we're putting how-to videos up and featured daily videos also. And it's a free membership site. It's ours. It's Infinity's. And you could also make special requests here and say, hey, I'd like you to set up this kind of chart for me. Could you help me? And I'll do it in video format. Thirdly, lastly, I'll leave you with the idea that we are a little old-fashioned. We have customer service reps here with phones. And once you do sign up for a demo account or a practice account for any reason, if you want to talk to a customer service rep, you have access to them and they will walk you through whatever issues you have or whatever questions you have. It's a free service. Feel free to use that, especially if you're not sure about futures trading. Remember, trading futures options on futures involves substantial risk of loss, not suitable for all traders. A lot of leverage and volatility here. So keep that in mind. If you're not sure where you fit on the risk capital curve, things let me know. Next event, we're going to be talking about the 10-year and the 30-year interest rate sensitive instruments. Okay, so that'll be an exciting one. And then we'll keep adding different market spotlights. And we all know where to find the crude oil one on our YouTube channel. Everybody take care out there. Have a great day. Thank you so much for spending time with me. Really appreciate it. Taking time out of your busy schedule. Have a great day.